typically, if we're looking at an Elliott wave count, one is very difficult to ascertain in terms of where it's going to move to. It's called a benchmark wave. But once one is in place, then we use that to ascertain what wave 3 and 5 will do. I do believe that my most optimistic model is looking for gold to test $2,700 by the end of this year, first quarter of next year.
Big news for the markets this past week. The NASDAQ dropped 3% on Wednesday, the biggest single day drop since 2022. The small caps have been rallying since the beginning of the week. The yen strengthened against the dollar. It was previously at a 40-year low. And now the gold price has hit a new all-time high. It's fallen a bit from its highs, but what's next? It looks like the gold price has been responding to the Federal Reserve and what markets believe is a rate cut by September, pretty much baked into cake at this point. Let's find out what's next for the gold price with our next guest, Gary Wagner, editor of thegoldforecast.com. And the first issue of my newsletter just launched today. Thank you for all my subscribers so far, all 1,200 of you so far. Please help spread the word. It's a recap of all, well, not all, but most of the past week's videos. If you can't watch the entire video, read the summary recaps, plus a bit of my own views, plus news to watch for the following week. It's completely free. Link down below to subscribe and read our issues, weekly issues. Read the first one, link down below. Gary, welcome back to the show.
Thanks so much for having me, David. It's great to be here.
Very exciting week for gold, new all-time highs. What was your initial reaction to this number?
Well, it's exciting. If you think about it, since April of this year, we have actually hit 3 record closing days or sessions. The first one was at 34, 35. The second one was 60. And this most recent one took us really to some real nice highs at around 88 in terms of an intraday high and about 75 in terms of a close. So it's been most interesting. We're witnessing history as we speak.
I want to talk about gold technicals with you. The obvious question is whether or not this rally is over. But before we get to that, Gary, let's talk about what the Federal Reserve Chairman Jerome Powell said in recent weeks. First, last week, he said,
we've said that you don't want to wait until inflation gets all the way down to 2%. Because inflation has a certain momentum. You wouldn't wait that long. If you waited that long, you probably waited too long because inflation will be moving downward and will go well below 2%, which we don't want.
So, yes, we know that the Fed doesn't necessarily need to wait until 2%. Exactly. He stated before that he wants to see data confirming a move downward, not necessarily a level of 2%. But this is a pretty explicit statement. How are you interpreting this?
Well, first of all, what was unique is that whenever he was asked about timing of the first interest rate cut, he would kind of throw it off and said, we're not really ready to discuss it. This time he said, we're actually we're getting greater confidence that we have seen in the past in that the recent inflation reports for the last 3 months have shown a consistent decline and that members believe that inflation is now on that trajectory to the Fed's 2% target. And so he actually didn't sidestep the question when he was asked about, well, will you cut rates in September? That's when he mentioned we're not going to wait until inflation gets to 2% before pulling the trigger. But the big thing, as far as I'm concerned, was that more than announcing a single rate cut, he is announcing that the Federal Reserve is pivoting from pausing elevated rates to actually beginning a interest rate normalization. In other words, if we look at the dot plot from June, they're looking at taking Fed fund rate, which is well over 5% right now, to about 3% by the end of 2026. And if they're doing 0.25% rate cuts, that means that they're cutting rates 7 to 9 times, depending on whether it's 1/4 or 0.5%. And that's what's important. It's not signaling one rate cut, but multiple rate cuts.
That was my next question. So Citigroup is projecting 200 basis points of cuts into 2025. That's, roughly 7 or 8 cuts down to 3.25% from 5.5%. What is your take there? Do you agree?
Well, that is in alignment with the most recent dot plot that was looking for that by the end of 2026. The call to have it done by 2025 is a little bit more aggressive than even the Fed is on record stating. I'll stick with what they have said, which is that they're looking to get the benchmark rate down to about 3%, and to do that by the end of 2026.
Let's take a moment now to talk about one of the most exciting commodity bull markets in recent years. Gold is soaring, and the copper price climbed to new all-time highs earlier in the year. Today's sponsor, American Pacific Mining, is seizing the moment by partnering with world-class miners to unlock America's next big copper-gold strike. The company is fully funded with a $14 million exploration blitz this summer and is nominated for multiple industry awards, including 6 by S&P Global. American Pacific Mining is trading on the Canadian Securities Exchange under the ticker symbol USGD, and in the U.S. on the OTCQX under the ticker USGDF. Click on the link down below or scan the QR code here to learn more about this company. In terms of the timing of the first Fed cut, the CME is projecting a 93.5% CME Fed Watch tool, 94% chance of a cut by September. Is that roughly in line with your expectations?
Yes, and what I found most interesting is 2 days ago, there was a 100% probability of a rate cut in September. It's diminished slightly, but I don't ever recall a point in time when the probability was absolute certainty, in other words, 100%. And it was at that level the day following comments by Chairman Powell at the Economic Club of Washington. It took a day for market participants to kind of soak that in and react to it.
You know, it's interesting because the probability jumped on July 11th when the CPI report came out for June, and the probability jumped to 85%. I remember that day, 85% by September. And, you know, what's fluctuated since then is, you know, I'm just curious to whether or not the inflation numbers were actually strong enough to suggest a Fed cut by September. I mean, yes, the last month's inflation number came down. It's now at 3% instead of 3.3%. But it's still nowhere close to 2%. So I don't know why the market is so optimistic with this 3% number. How would you respond to that? Yeah,
I think that the market itself is coming into more alignment with reality than previously. They were well over optimistic months ago when every Federal Reserve official was saying, "Look, we're not ready to talk about cuts." They were pricing in a cut. Now they've actually opened the gate by Powell answering, "Are you ready to cut rates in September?" by responding that we're going to cut it before inflation gets 2%, was Fed speak for it's highly likely that they will initiate the first rate cut in September. And that's why you had that 100% certainty by the CME's Fed Watch tool. I think that market participants are in much better alignment with reality now than they have been in the past. I think in the past they were overly optimistic and got hurt because of that.
So what was gold responding to exactly? I mean, there's a few ways to interpret this. Lower interest rates could be good or bad for the economy, depending on how you look at it. The dollar went down. That could be another trigger for gold. What do you think happened?
Well, I think that the fact that they're talking about interest rate cuts and given some idea of the timing of that first cut, as I said, signals the beginning of interest rate normalization. And now it is becoming very, very roughly matched to the last dot plot that was anticipating 2 rate cuts this year, 3 the following year, and I believe 3 in 2026. Prior to that, in March, the dot plot was looking for 3 rate cuts this year. And so that diminished because the data did not back it. And multiple times, Powell, along with other Fed members, said we need greater confidence. We need more data. This time he said we're actually getting the data that we had hoped to get to give us that confidence. And so it's a huge change in the word track that Powell is using. And all of his statements are slightly veiled. He doesn't want to give away too much, but this time he definitely changed his basic outlook to say that, look, we're ready to go.
Can we pull up a gold chart now? Let's take a look at what happened this week. It seems like the rally is over for now. Gold has been pulling back from its new all-time high, and now we're sitting at around 24.44, which was roughly the same price as it was a couple of days ago.
Right, right.
So the question is, what? Yeah.
Oh, I'm sorry.
No.
We're looking at a daily candlestick chart of gold. And if it starts really about the middle of February when gold was sitting at around 2000, and then you can see where my pointer is right now. In the middle of April, it hit the first of 3 all-time record closes. This one coming in at roughly 39. It then retraces and then moves to the second of, and the market's moving so fast, the second occurrence, and this one came in at 2460. It then retraces back down to about 2300, and then this last rally is really from 2300 up to 2488. And what you see is a basic Fibonacci retracement of the data set from 23 to 2488. Now, gold right now has sold off for 2 days, and that's these red candles here, and it's very close to a 23.6% fib retracement. That's an acceptable but shallow correction. A deeper correction would be the 38.2% fib retracement. That comes in at around 2420. And my sense is, all things being equal, if gold continues to decline, we're getting a correction here. And I believe that this, as long as it doesn't fall out of bed, meaning break below 2400, I believe that it's still exceedingly bullish, because we had a tremendous move of $188 from 2300 to 2488. If it comes down to 2420, it will then recycle and move back into a rally mode, which has to, if we're looking at gold trading with higher highs and higher lows, which is what we've seen recently, then we would expect gold to trade much higher and actually challenge 2,500 per ounce. And that's what we're seeing here.
Okay, so here's a fundamental take on what gold could do next. I mean, technicals aside, if we assume that the gold market has already priced in a Fed cut by September, or perhaps even subsequent cuts, why would it need to go any higher from here?
It would go higher from here under the assumption, first, we have political uncertainty, we have geopolitical uncertainty, and we've got a very, very strong possibility that there's going to be, whether it's political or geopolitical issues that come up in the future. So why would gold continue to go up? I think it's because market participants have been waiting so long for interest rate normalization. We're getting gold reacting to lower moves in inflation rather than higher moves. And I think that the trend is higher because what we're going to see is the dollar weaken. I think that that's going to be a big component, is that we could have a extended period of time of dollar weakness. And of course, there's an inverse relationship between gold moving up and the dollar moving down.
What's it going to take for gold to breach 2,500? That's been like, the aspirational level that we haven't breached yet this year.
I think that we already have those steps kind of set in. In other words, if the Fed actually does cut rates in September, which most analysts believe is a high level of probability, then that's signaling a series of cuts. I believe that we'll see 2 rate cuts this year. And with each rate cut, we're getting that upward momentum in gold. What is happening is, one, you still have central banks continuing to buy at record levels, okay? You have different hedge funds as well as speculative funds entering into the market. So you've got a lot of activity by central banks and by large institutional traders kind of jumping on the bandwagon, creating that upward momentum. And when you have that much volume kind of weighted to the buy side, it's going to move gold prices higher.
Is there a downside level or floor that you're concerned about below which it would be a renewed bear market?
Well, It would have to break below $2,400 per ounce. 2,400 was resistance up until just recently. Once it broke above that price point, it really shot up over the period of about the last week in trading. And from that point, resistance became support. And so as long as that support level holds, I would be exceedingly bullish. And the only real target is to take out the previous all-time record close, which came in at about 2460, and the all-time intraday high, which was 2488. So that's what, $12 away from 2500. It's not that far. And I don't think that it is a big stretch to look for gold to at least challenge 2,500. Now, if gold challenges it the way it challenged 2,400, we would expect to see a couple moves above it, only to fail. In other words, it would trade, maybe go to 25.10, 25.12, and then come back down, maybe challenge it again. In the case of 2,400, it took 3 attempts before 2,400 became support rather than resistance.
I know you and I have talked about the notion of gold being a hedge against equity volatility, meaning if stocks go down, gold goes up and vice versa. Although this year what we've seen is more or less a broad move in tandem with the equities markets going up and gold reaching new all-time highs consistently over and over again. Does this move this year change your perception of gold as a hedge at all?
Actually, not at all. Typically, you have the reason it's called a risk-on investment asset, risk on and risk off, is they tend to work against each other. When people are moving into equities, they're not moving into the safe haven aspect of gold. The only time when you get them moving in tandem, and historically speaking, there's a lot of data to support that, is during points in which the Fed is heavy-handed in intervention, and that's what we're seeing now. Whether they're raising rates, as we saw after 2021, or lowering rates, normalizing them, the only time you get equities and gold rallying is when the Fed is heavy-handed and immensely involved in monetary policy decisions that affect interest rates.
I'll point out that the interest rate cut hasn't happened yet. So a lot of it is really just based on hope, isn't it, Gary?
Absolutely. It's based on the optimism that they will. Yes.
Okay. Is gold signaling a recession at all? That's one narrative I've heard. Do you agree with that?
Right now, all the data is pointing to a soft landing. In other words, we did see the labor market cooling. We do see inflation moving down. And at the same time, we've got fairly good GDP or strong economic growth, which points to the possibility of a soft landing. And I'm in the camp believing that the Fed might have pulled off the miracle mile, so to speak, and that is a soft landing after they have really addressed 9% inflation back in March of 2022 by beginning an aggressive series of rate hikes. And they did that. They took interest rates from near zero to over 5% and did that over a 2-year period. That's aggressive. And that kind of action, if followed by interest rate normalization, is going to cause both equities as well as gold prices to move back in tandem to higher values.
Well, everyone's talking about what the election result would do to stock markets, whether a Trump win or a Biden win would mean stock markets go up or down. And the reality is, if you look at history, it's been mixed. Democrat, Republican wins have not been they haven't been solid indicators for where the stock market's going to go, because stock markets have gone up during Biden. They've also gone up during Trump. And so my question is whether or not you looked at this same analysis for gold.
In terms of the ramifications of the upcoming elections, I'm kind of standing on the sidelines because I don't know. I believe the one thing that it could enhance is uncertainty. And anytime you have uncertainty, whether it's political uncertainty or geopolitical uncertainty, you tend to see gold move higher because it is a safe haven asset. Equities are reacting to the fact that interest rates are coming down, and that's good for business. When the cost of borrowing capital is reduced, that's a positive, it creates positive tailwinds for US equities. And so we are in kind of that perfect storm scenario where you have uncertainty and a strong economy and the possibility of a soft landing all occurring at the same time after we have had some troubling times, economically speaking, back at the end of 2021 and the beginning of 2022. And that's when inflation spiked to over 9% for a short period of time. So the Fed has done an excellent job at bringing inflation down from 9% to 3%. And according to them, inflation is now back on a trajectory to its 2% target, which it was not during the first quarter of this year because we saw some reports that showed an uptick in inflation rather than a decline.
Okay, let's zoom out and take a look at the longer term chart now, Gary. The recent moves in gold, how does that fit to your longer term cycle analysis?
Well, what I'm looking at in terms of where I think it could go, let me just go ahead and pull this up.
Yeah.
This is my longer term analysis itself, and this has to do with Elliott wave and pattern identification. What I found was interesting is back in December, we had the first of two occurrences of a descending top, meaning a series of lower highs and a flat bottom, in other words, equal highs. We then had a tremendous spike that started mid-February, taking gold from about 2,000 to its first of all-time record closes and highs with an intraday high of 24.72. The second one occurred in the middle of May, and this most recent one occurred a couple of days ago. So we have seen three moments in which the all-time record close and intraday high was taken out. And what does that mean? If in fact we're looking that we have finished our series of corrections, because I believe that once we hit the first record high back in May, we had a pretty deep correction from about 2480 down to 2300, so about $180 correction. We then saw this double bottom about 2.5 weeks apart, and then a move back up and beyond that, which tells me that even if gold corrects here and moves back to, say, as I said, 2420, I believe that it will then enter a bullish rally cycle, taking it back to challenge 2500. Now, in terms of where it could go, and this is one of many possible models, there are a few models that I'm looking at, and obviously this is quite optimistic, but this is assuming that what we're witnessing with this recent high near 2,500, if we have a correction that goes to about 2420, it's a 38.2% fib retracement. Typically, if we're looking at an Elliott wave count, one is very difficult to ascertain in terms of where it's going to move to. It's called a benchmark wave. But once one is in place, then we use that to ascertain what wave 3 and 5 will do. And what I've done is basically a 1.618 extension of the move that we saw in wave 1 to wave 3, and that would take gold to about $2,700. And I think that that is very optimistic. It's very bullish, but it's also probable. And I wouldn't have said that at the beginning of the year. In other words, you have to look at what's happened over this last year. And we have seen gold gain tremendous value in a relatively short period of time without geopolitical issues coming into the mix. In other words, people are talking about the economy, about what the Federal Reserve does, and we're not so focused on the war in Ukraine and the issues in the Middle East anymore. Those have kind of moved to the back seat, and everybody's focused on what the Federal Reserve is going to do. And so I do believe that my most optimistic model is looking for gold to test $2,700 by the end of this year, first quarter of next year.
Okay, well, I appreciate you applying a timeline to that. A lot of people don't. Now you're not alone in being bullish on gold. A lot of people are, and during a bull market, it is natural for people to turn bullish. But Gary, I do wonder whether or not this is a crowded trade. In other words, too many people are becoming bullish, and whether or not this actually is a bearish indicator. How would you respond to that?
Well, you can always take that contrarian theory approach. My response to that would be that if that was the case, why would you have such a presence by central banks buying huge amounts of gold to add to their balance sheet, to their assets? That's not speculative purchases. In other words, when you have a large move in a market that can be tied to speculative buying or speculative selling, that can be short-lived. But when central banks become involved, that to me is a much longer term stance, and it's a much more serious level of purchasing by such that's countries buying gold and holding on to gold and moving fiat currencies into a hard asset such as gold. And I think that has to be really factored into the equation of, could this be really short-lived, and could the roof fall in, so to speak? Not as long as central banks are one of the larger or predominant players in gold right now, and they are. And that to me speaks spades of the possibility that this will be an extended rally and take gold to all-time record highs that we haven't seen.
Okay, excellent. Thank you for your analysis, Gary. And we'll speak again next time. Before we go, tell us where we can find you.
Thanks so much. Thegoldforecast.com, of course, is our premium website. Our YouTube presence is The Gold Forecast. And my Twitter handle is Gary S. Wagner, at Gary S. Wagner.
Perfect. We'll put the links down in the description below. Appreciate it. We'll speak soon, Gary.
Thank you so much.
Thank you for watching. Don't forget to like and subscribe.